PepsiCo, stock ticker PEP, just released their latest quarter's earnings, and this is a company that a lot of dividend investors have had their eye on over the last year or so. We can see in the last year they're now down about 18%. So if we look at that starting dividend yield on a forward-looking basis, it's sitting at about 4.2%. Now, going into this earnings report, expectations were extremely low. If we look at last quarter's earnings, yes, they did beat on revenue, but they saw misses on earnings. And if we look at the upcoming quarter's earnings expectations, look at the earnings per share revisions over the last 90 days. They had 0 bullish revisions and 13 bearish. So analysts continue to revise their expectations lower. So this could be considered a good thing for Pepsi because expectations were low. So if we look at their earnings report, we can see they actually saw beats on top and bottom lines. Q2 non-GAAP earnings per share of $2.12 was beat by about 9 cents, and revenue came in at $22.73 billion, which was only up 1% year over year, but was a beat by about $430 million. So all in all, so far, that's a good sign for the company. Now, if we go over to PepsiCo's release, we can see in the second quarter, net revenue performance was up by about 1%, but if we look at year to date, it's still down a little bit compared to the prior year. And on top of this, if we look at the foreign exchange impact on revenue, it's actually down by about 1.5%, compared to the net revenue performance of up 1% in the second quarter. The same is true year to date, which basically means that currency fluctuations are reducing reported revenue growth, which basically means that currency fluctuations are reducing some of the reported revenue growth. Now, the good news is if we just simply look at organic revenue performance, they're still seeing very low growth, 1 to 2%, but overall the core business is still seeing some growth. Now, what's interesting about Pepsi in this recent quarter is all the growth is really coming from one area. If we look at the food division and the beverage division in North America, revenues were both declining. If we look at the food and beverage division in North America, revenues declined for both of these divisions. But if we keep scrolling down, look at Latin America foods. Revenue was down significantly. In Asia Pacific, it saw very little growth at 0.5%. But if we look at Europe, Middle East, and Africa, revenue actually saw an 8.4% growth rate year over year, so good growth in that area. And because of this, the international beverages franchises as a whole actually saw about 3.2% growth year over year. This is really probably the one bright spot when it comes to revenue growth for Pepsi. Unfortunately, in the grand scheme of things, it doesn't change too much. For example, if we go ahead and jump over to the stock screener, let's look at Pepsi and go ahead and look at revenue over the last few quarters. Now, what we can see from Pepsi, we already knew to be true. Revenue growth has been slowing, and historically speaking, Q2 revenue has been higher than Q1. For example, Q2 2023 revenue came in at about $22.3 billion. If we look at it in 2024, about $22.5 billion. And again, like we already pointed out, revenue this year came in at $22.73 billion for the second quarter. So very slow growth, just up 1%. Now, perhaps just as important as this earnings report is the guidance management continues to give us. If we scroll down on this earnings report, we can see for 2025, the company continues to expect a low single-digit increase in organic revenue, core constant currency EPS to be approximately even with the prior year. So essentially no earnings growth, a core annual effective tax rate of approximately 20%. And here's where things get really interesting. Total cash returns to shareholders of approximately $8.6 billion, with about $7.6 billion of that being dividends and share repurchases around $1 billion. Now, this is why most people are buying the stock right now. They know they're going to get a handsome dividend payout. But this is where things actually get a little bit muddy. If we jump over to the dividend breakdown sheet and look at Pepsi, the data will load in, and like always, if you'd like to be able to download any of these spreadsheets and get access to the ticker data add-on on Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. Now, like we already know, at least on a trailing 12 months basis, that dividend yield is still above 4%. Pepsi's a dividend king with over 50 consecutive years of dividend payouts, so that dividend has been growing over the past decade, and they have a 5-year dividend CAGR of about 6.4%. But again, let's talk about the number they just gave us, the one that's so interesting when we put it into perspective. They told us they expect to return total cash to shareholders of about $8.6 billion. What's interesting about this is last year, the company only generated $7.1 billion in free cash flow, close to 7.2. Now, we have to always remember capital allocation. This is such an important concept. I harp on it all the time, but there's 5 different ways a company can use free cash flow. They can reinvest it back into the business, attempt mergers and acquisitions, pay down debt, do share buybacks, or pay out dividends. And these are the 2 ways to directly reward their shareholders. Now, over the long term, a company can't use more in free cash flow than they generate. So, for example, if they generated about $7.2 billion in free cash flow last year, they can't continue to spend more than $7.2 billion on each of those categories, and they certainly can't expect to pay out more than $7.2 billion in dividends. But if we look at the dividends paid out last year, that's exactly what happened. This gave them a free cash flow payout ratio of over 100%. And in fact, this ratio has been extremely high for the past 3 years. It's a pretty big red flag. We can see in the previous year, the free cash flow payout ratio was about 84.3%. In 2022, it was 110%. In fact, Pepsi has never had a year where they've generated over $8.6 billion in free cash flow, but despite this, they're still projecting to return $8.6 billion to their shareholders with dividends and share repurchases. Now, that can at times be sustainable if a company has a very healthy balance sheet, so let's just take a look at that balance sheet for Pepsi. If we go ahead and zoom in and take a closer look at these metrics, right now we can see total long-term debt has been increasing. It's sitting at about $39.4 billion. If we look at total debt, that's sitting at $48.5 billion. And right now, cash and cash equivalents sitting at about $8.2 billion and total current assets sitting at $26.2 billion. So I wouldn't necessarily say Pepsi's balance sheet is extremely weak or anything, but it's not like they're sitting on a massive cash position. So because of that, I think it is completely fair to be pretty concerned about the capital allocation plan for Pepsi right now. We're talking about a company that aims to pay out more in dividends every single year, but they just told us revenue's not growing, they told us earnings aren't growing, and free cash flow isn't likely to grow if that's the case as well. So the only way they can currently make these dividend payments is by continuing to weaken the balance sheet. That's not sustainable over the long term. So yes, while in this recent earnings report, Pepsi did manage to beat expectations, which is a good sign. Maybe we'll see a little bit of bump up from Pepsi over the next couple of days due to it. But there are still some pretty serious long-term concerns with this stock right now. On top of this, Pepsi just used significant free cash flow for mergers and acquisitions when they acquired Poppi earlier this year. Now, the net cost of this acquisition was about $1.65 billion. To be fair, if this acquisition can prove to be quite profitable, then this could be a good move for Pepsi. The management team has continued to state that they're looking for strategic acquisitions to make because organic revenue is growing so slowly. So was this a good move for Pepsi? That still remains to be seen. But the reality is this stock is trading very close to a 5-year low right now. There's still a lot of concerns investors have even after the earnings beat. With that being said, has the sell-off gone too far? Is the stock a good opportunity at around $135, $138 per share? Well, let's go ahead and jump over to my stock valuation sheet. We'll zoom out. Let's come up here and plug in Pepsi. Now, there's two valuation models that I want to pay close attention to in this scenario. The first one will be the historical multiple valuation. Now, what are we doing? Well, we're looking at the historical PE ratio for Pepsi compared to how it's trading right now. So when we look at this charted out, we can see an underlying trend. The amount investors are willing to pay for Pepsi has been going down over the past few years, while the average PE ratio for this stock in the last decade is about 25.88. Well, for the trailing 12 months, it's sitting at 19.82, so investors have been paying about 23.4% less for Pepsi in the last year compared to the historic average. Now, here's the big question. Is this justified due to the fact that Pepsi is growing revenue, growing earnings, and growing free cash flow at a much higher rate? Stocks that are growing these things at a high rate warrant a higher PE ratio, and the reality for Pepsi is this is probably warranted. I think the reality is it's low because there's not a lot of earnings growth projected. Now, on top of this, I do want to look at a dividend discount model. This is valuing the stock based on how much it's paying out in dividends and how much that dividend will grow in the future. And historically speaking, Pepsi has done a good job of growing that dividend with a 5-year dividend CAGR of about 6.4%. But the reality is they're growing that dividend at the expense of the free cash flow payout ratio continuing to climb higher, which, as we already know, is not sustainable. So what type of dividend growth should we expect moving forward? Well, again, the dividend growth isn't sustainable if free cash flow is not growing. So even with a dividend growth rate of about 2.5%, you could see our dividend discount model price per share is only $93.74, which is still 30% lower than the current share price. So how fast do they have to grow that dividend to justify a $135 share price? Well, let's bump up this growth rate to about 4%, maybe 4.25%. All of a sudden, we start getting very close to the current share price. So the market is still pricing in about 4.25% dividend growth into Pepsi stock. Whether or not the stock is overvalued or undervalued depends on whether or not you think they can hit that number. I personally think that'll be a little bit more difficult for Pepsi in the short term. So when I look at this company, yes, the recent earnings report was great, but there's still some serious problems behind the scene right now. Mainly, revenue and earnings simply aren't growing, and the company is paying out more in dividends than they're generating in free cash flow. And it sounds crazy to say for a stock like Pepsi, but if that continues to be the case moving forward, then that dividend could be at risk. I think Pepsi has time to turn things around, and although I don't own the stock, I still hope that's the case because I do own SCHD, which has a decent bit of exposure to Pepsi. So go ahead and let me know what you think of this company in the comments down below if you plan on buying or selling, and like always, if you'd like to download any of these spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.